Hey everyone, and welcome. Today we're diving into something pretty fascinating, a financial instrument that literally connects your investment to a real physical thing. We're talking about Sukuk. You might have heard them called Islamic bonds or Sharia-compliant investment certificates.
All right, so let's just start with a simple question. What if you could invest in something you could actually, point to, like a building or a big piece of machinery, something tangible? How would that even work? That's really the core idea we're going to unpack today. So in this explainer, we're going to get right into the nuts and bolts of how this asset-backed idea actually works. We're going to see how your money can turn into a piece of ownership in a real asset, and more importantly, how it generates a return for you. Okay, so to make this super clear, forget the theory for a second. We're going to walk through a really straightforward concrete example. We're basically going to build a sukuk right here from the ground up so you can see exactly how all the numbers add up. All right, first things first. Every investment has a starting point, right? So for our example, let's say the total size, the principal, is $100 million. Now, this isn't just some random number. It's the actual value of the physical asset that all the investors are chipping in to buy a piece of. Okay, next up, how long does this thing last? The timeline. For our example, we'll say the term is 5 years. Think of this as the maturity period. It's the amount of time that asset is going to be leased out, making money for the investors, before it's sold off at the end. And here's the part you're probably most interested in, the return. We're looking at a 6% fixed annual rental rate. This is the key. This is the income that the asset is supposed to bring in every year from being leased out. And it's really important to get this. It's not an interest rate on a loan. It's a rental fee. It's just like if you owned a house and rented it out. So how does the payout actually work? It's surprisingly straightforward, which is what I love about this. In our example, let's say investors get paid every 6 months, so semi-annually. You just take the $100 million principal, you apply that 6% annual rent, but since it's for half the year, you divide by 2. And boom, that gives you a $3 million payout every 6 months. It's completely transparent and tied directly to the rent coming from that asset. So what happens at the very end when those 5 years are up? Well, it's pretty simple. The asset itself gets sold, and that original $100 million principal gets returned to all the investors from that sale. And that's it. The whole investment cycle is complete. Okay, but wait a minute. What if the economy goes wild? Interest rates are changing all the time. A fixed rate for 5 years might not always be the best deal. Well, good news. This kind of structure can actually be really flexible. Let's check out how it can adapt with something called a floating rent model. So, a floating rent, it's pretty much what it sounds like. Instead of being stuck at that 6% for 5 years, the rental income can actually move up or down. It's tied to some kind of public benchmark, which lets the return kind of, float, along with what's happening in the wider market. Now, obviously, to keep things fair, this can't just be random. There are some really strict rules. The formula for how the rate changes has to be totally public and clear right from day one. For instance, it might be something like a known benchmark rate plus, say, a 2% margin, and you know exactly which dates the rate will be adjusted. Plus, if there are any caps or floors, like a maximum or minimum rate, those have to be spelled out too. The whole point is transparency, no surprises. Okay, all of this, the fixed rate, the floating rate, it all leads back to the one core principle that really makes this whole thing unique. And it all boils down to one simple question. Where is the money actually coming from?
And this is the absolute key difference. With a suku, your return comes from a share of the profits, the rent, from a real asset that you actually own a piece of. With the conventional bond, the return is interest. It's just a fee you get for lending out your money. And this distinction is everything in Islamic finance, which prohibits earning interest, or what's known as riba. The idea is to avoid profiting from debt itself, and instead to share in the actual risks and rewards of a real business or asset.
Yeah, this quote really just nails it. The cash you get comes from the actual usefulness of an asset, not from a fee on a loan. That is the fundamental idea right there. So we've gone through the numbers, the models, all of it. What's the one big idea you should really take away from all this? Let's just boil it right down to the essentials. It's this, right here. Your investment is tied to a real, identifiable asset. You're not just lending money to someone, you're a part owner. You share in the upside if things go well, and you share in the risk if they don't. That is the asset-backed principle, plain and simple. And that brings us to a final, pretty big question to think about. I mean, we live in a world of crypto, of NFTs, of all these super abstract digital products. So, what's the value today of an investment principle that's tied to something, real? What's the place for an asset backed idea in our modern economy? Definitely something to chew on. Thanks so much for joining me for this explainer.